Well, good evening and welcome to this live stream on the 24th of February 2026. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thanks for taking time out of your Tuesday evening to spend it with us, and appreciate the regulars popping in, and I see a few new people too. So welcome. Great to have you on this evening. And this is a really important conversation because we do get deep and dirty into data, particularly at the moment, but also try and paint a broader picture and also talk about some of the policy options that should be on the table. So all of those things will be there tonight. As always, if you'd like to ask a question, you're welcome to as we go through. I will remind you that we don't provide specific financial or property or legal advice. It's a general conversation. We moderate the chat, but put your questions, comments, suggestions as we go. If you have a specific question, if you use that Walk the World DFA, you'll get into my queue and I can bring you in. And I've also enabled Super Chat, which means you can get your question top of the list or indeed make a contribution to what we do around here. Really appreciate those who support us, whether it's via Patreon, whether it's via Super Chat or via PayPal. Makes a huge difference for us to be able to do this. We don't do this for profit. We do this because we think there's a really important conversation to be had. So let me bring Leith straight in. Leith, welcome back. Love to see you on the show once again.
Yeah, g'day, Martin. How's things?
Yeah, very good. Very busy. I've had a very large number of people asking me to try and help them understand what's going on with this crazy property market. It's so many it's a switch back, ups and downs, round and round. So very busy, but very interesting. And the modeling, of course, shows that mortgage stress and rental stress are still very high. Interest rates probably going up. We've got Albo saying, no, we're going to keep migration high, and we'll talk about that perhaps. And more broadly, what I wanted to do at Leith was to try and join the dots for people, because it seems to me as I have my conversations that the connection between migration, property and the housing crisis, and the productivity question and some of the other stuff around it, they're all connected, right? And I quite often find that people see a bit of the puzzle, but not the jigsaw puzzle in its entirety. And hopefully we can paint the picture a little bit as to how all the pieces are connected and why it is that, if you do bang migration up, that has an impact on property prices. Or if you have poor productivity, that has a significant impact on interest rates, which of course in turn has an impact on house prices because mortgage rates go up, all of those things. So it's trying to put the puzzle together. And I think that'll be a really fruitful conversation. But we should just...
Yeah, absolutely. Yeah, sorry, I was going to say, I've actually, I've had a few conversations on this topic, actually, recently on the radio. So last weekend on Radio 2GB and 4BC, I do a weekly Treasury of Common Sense on Saturday morning. We actually talked about this productivity thing in detail. So I think it'll segue nicely into this conversation.
Yeah, absolutely. And it's worth saying, I think, that, there is, of course, always conjecture and some people saying, no, migration is not part of the problem. Housing prices completely independent of what happens to population growth. We will get into that because I think the data's pretty compelling. But Leith, for those who may not have come across you before, just give us the 30-second lift view of Leith and what you do and what you've been doing, because it's really important that people understand where you're coming from.
Yeah, okay. So I'm an economist, former worked at the Australian Treasury, the Victorian Treasury, then did 5 years at Goldman Sachs, where I actually didn't work as an economist in those 5 years. I worked as a regulatory capital guy, basically working out how much capital had to be held against loans and financial positions and that sort of thing. And then after I got sick of doing that, I basically started up macrobusiness.com.au with another guy called David Llewellyn-Smith, and been doing that for about 13 years now, or maybe we're in the 14th year. I've sort of lost count now. And basically that's my day job, as well as doing a whole bunch of media, and then also have an interest in Nucleus Wealth as well, in the macro business fund, just like you do. And basically, yeah, that's pretty much my 30-second bird's eye view.
Excellent. And I would say that your media commentary and shows are always on your channel. We'll come to that at the end of the show. There's a really lot of good stuff that you pump out. And folks, if you've not joined up with the macro business information flow, it is by far the best and richest in Australia. So, and of course, Tarek is also a contributor. And of course, I have Tarek on my show, and I have Damien Klassen. So we're sort of all sort of in this sort of morass of connectedness. But it's because we believe that there's a really, really important conversation that needs to be had about the economy and economics. And frankly, the mainstream are doing us, well, no great service at the moment.
Yeah, they're not, unfortunately. So, as always, on pretty much every policy issue, if there's talk about reducing migration, they come out with a whole bunch of scaremongering rubbish. And, basically the mainstream media just seems to want to keep the status quo going, which is a status quo that we've been running for pretty much most of this century, and it hasn't worked. And we know it hasn't worked because we've got an incredibly expensive housing market, both to purchase and rent. We've got deplorable productivity growth in this country, and we've got living standards that are basically going backwards, and shocking income growth, etc. And you have to, when you step back, you got to ask yourself, how is it that a nation that is blessed with abundance of wealth, where we got arguably the most natural wealth in the world per capita, actually, maybe Brunei or some of those places, small oil exporters have more, but we are absolutely blessed with almost everything that the world needs, and we should be one of the richest countries in the world. But instead, we've just, as Don Horn said, all those many decades or generations ago, that we're unfortunately a country that's lucky but run by below average people, and that is really ringing true now because we have just shot ourselves in the foot in so many different areas. I mean, we being politicians and policymakers. And as a result, we've just got really poor results. And yet the media class, the political class, just wants to keep doubling down on what hasn't worked for 20 years and just wants to keep that going for another 20 to 40 years or more. That status quo is what they want to continue. And it's just the definition of insanity is repeating the same things over and over again and expecting a different result, because we've already seen how it's going to play out. And if we keep doing the same things, we're just going to keep getting the same poor results.
Yeah, and I will make the point that more and more when I speak to people in my one-to-one conversations, which I still run, the gap between the perception as portrayed in the mainstream media and amongst the politicians, Spin Jim and all that, and what people are really feeling, looking at their individual household finances and trying to sort of juggle the budgets and trying to sort of find somewhere to live, whether it's in the rental sector or buying a property, the gap is getting wider and wider and wider. And I believe that that's one of the reasons why the latest polls are showing that One Nation is shooting up the ladder, right? Because people are so frustrated with the existing political system and the fact that it is disconnected, absolutely disconnected from many people's reality.
Yeah, and let's be honest, we've got a uni party here, and Labor Liberals, same thing, and the Greens are hopeless. Their policies are terrible, and basically virtually every single opinion poll for the last decade plus has said that Australians want lower immigration, and because it's not because they're racist or anything, it's because the migrants themselves actually want lower immigration as well, because they often live in the areas that are getting crush loaded the most, so they don't like it either. But it's a lived experience thing, because we keep, fire hosing in hundreds of thousands of people every year into our cities, which are already jam packed, where we've got housing problems, lack of infrastructure, lack of services, those sorts of things. And everyone's standard of living is not improving. And the material standard of living, if you want to look at household incomes and that sort of thing, is terrible. Like, we've had very little growth in a very long time in those things. And as a result, people are going, well, what are we doing here? Like, none of this is working. And we've obviously got One Nation serves as the protest vote. Like, they're obviously the only party that's vocal about lowering immigration. So whether or not you think that, you agree with them in other areas or whatever, people are like, well, you know what? I'm jacked to this, so I'm going to go to there. Now, I think the Albanese government's actually playing into it on purpose, because they know that the more people go to One Nation, the more it's going to basically divide up the conservative side of politics. And it means that Labor is just going to remain in power, right, as the default party that'll get all the preferences from the left, etc. And, the coalition and One Nation will end up splitting votes and that sort of thing, and you'll get leakages. So I think this situation actually suits Labor to keep the status quo going, even though it's, very cynically for their own political gain, even though it's going to send the country down the toilet. It's quite unfortunate.
Yeah, and in fact, there was an article on macro business I think David put up, which was
Yeah,
just this point, right? And I think it's a brilliant point that actually Albo wants to continue to drive this agenda because the other side get more fragmented
yeah,
than his
it's a wedge.
side. It's a wedge. Yeah, I think that's a really, really important point. Well, let's just sort of think about this jigsaw puzzle a bit with the housing, productivity, and all the other stuff. Now, you've actually talked about the four horsemen, right? And I think that's a really good way to perhaps get into this conversation. All of the factors that are effectively all biting and fighting each other, and effectively driving ultimately towards the chaos that we've got at the moment. So, where do you want to start the conversation?
Yeah. So first of all, I'll just give a quick. I've got some charts here, basically showing Australia's deplorable income growth. So you've got real wages on the left hand side of the chart. Now, the wage price index is basically measures the change in a basket of wages, right? So it tells you if you're getting wage growth across jobs. So it doesn't factor in people changing to a different job, etc. It's just it measures job for job. And what this shows is that the latest data, which came out last week, shows that Australia's real wages, and that's shown in the blue line, is tracking at sort of late 2011 levels. And the scary thing about this is, so what I mean by that is it's tracking about 6% below its pandemic peak. Now, what was concerning about this is the Reserve Bank of Australia's latest statement of monetary policy that was released earlier this month. They actually forecast, so they have forecasts in the back of that, where it has basically forecasts for wage growth and forecasts for inflation. And between those two things, you can then get a forecast for real wages. And that's shown in the red, the little red line at the end. And what the RBA shows is that basically by mid-2028, which as far as their forecasts go, we're effectively going to get no wage growth again. So by mid-2028, we're still going to be tracking at the same level of real wages that we had in March 2011. So this is a massive haircut in our purchasing power. And I also yesterday pulled some the latest household disposable income data from the OECD, because that was just released. And over the last decade, so I think I did the March quarter of 2015 to the third quarter of 2025. So decade and 6 months, basically. What that data shows is that Australia has had the poorest growth in real per capita household disposable income out of English-speaking nations. So unfortunately, New Zealand, they don't have data on that. But if you compare it to Canada, US, UK, and we've also been our growth in real per capita household disposable income in that 10 and a half years has only been 5.9%. And the OECD as a whole has grown by 20.1%. That's shown in red. And obviously, Canada's done very poorly, UK's done very poorly, but even those two countries have had better growth in real per capita household disposable income in the last 10 and a half years than Australia. So this story here is that Australia's material living standards, I'm saying material meaning your purchasing power, not your other things like, your quality of housing and how long it takes to drive to work and those sort of things, which are more qualitative indicators. But material standard of living in Australia has not improved, or it's barely improved, and it's gotten worse relative to other countries. And the key reason for that is shown on the chart on the right, which comes from Justin Farbo at Anybody in Macro. And what it shows is that Australia's productivity growth, so that's GDP per hour work, so that's how much Australia produces in goods and services per hour of work, has actually been amongst the very poorest in the world over the same decade. That's shown in black. You can see Australia right at the bottom of the axis had very poor growth. So effectively, if Australia wants to have higher living standards or growing living standards, we've got to grow productivity. But unfortunately, we've got four factors that are basically working strongly against Australia experiencing strong productivity. So I call these the four horsemen of the productivity apocalypse. And, the first one is a more short-term factor. Actually, no, I'll do the longer-term factors first, then I'll go to the short-term factors. So long-term, Australia's basically been growing its population through immigration more aggressively than virtually every other country in the OECD, other than, I think, Israel. So this century, or to the end of 2024, Australia grew its population by 45%. And that was 2.5 times the OECD average. And that's obviously been driven by huge immigration. So since the turn of the century, Australia's net overseas migrations averaged about 225,000 a year. That's since 2000, which is an extraordinary number. Like the 60 years after World War II, we averaged 90,000 a year. And over that 60-year period, we only hit 150,000 net overseas migration twice. So we massively ramped up immigration. The problem with it is if you grow the population aggressively via immigration faster than business investment, faster than you build housing, and faster than you can build infrastructure, you get what's called capital shallowing or capital dilution. And Australia's capital dilution is basically shown brilliantly here by Jared Minack. It's the second chart from the right in this slide. And what's happened is because we've grown our population a lot faster than we've grown business investment, infrastructure, and housing, etc., we've actually had declining productivity per worker. And just next to that chart, there's a fantastic chart, another chart by Alex Joyner, IFM Investors, and actually tracks Australia's business investment by component. And you can see that while Australia's population growth boomed from the mid-2000s, investment in machinery and equipment as a share of GDP fell. So what that means is if you've got a growing population, you're investing less in the machinery and equipment, that means that each worker gets less machinery and equipment to work with. And what that means is that they become less productive. Now, I've used this example before just to try and explain this capital shallowing problem, but it's just a very stylized, basic example to try and give people an easy way to understand it. So if you're running a cafe and you've got 2 staff operating one coffee machine who can churn out 100 coffees an hour, if you double the number of staff to 4 and you don't double the number of coffee machines, you can't double your output, right? So you can't suddenly produce 200 coffees an hour because you've got to share that machine and you're going to get congestion, have to wait for each other, you'll bump into each other in the kitchen, etc. So what you have there in that cafe is capital shallowing. You've increased the number of workers, but you haven't given them enough machinery to commensurate amount of machinery to work with. And as a result, their GDP per hour worked, so in this case, GDP is coffees produced, reduces. So if you're going to double the number of workers in the cafe, you need 2 coffee machines instead of 1 coffee machine to keep the capital to labor ratio constant. Well, effectively, the Australian economy hasn't done that. We've grown the population by 9 million so far this century. So if you use the latest population clock, that's a 47% increase up until now. And we haven't grown business investment, as you can see by that new machinery and equipment chart, especially, or infrastructure. So we haven't kept infrastructure, which means you spend more time stuck in traffic and you become less productive there if you're driving trucks and that sort of thing. And also we haven't grown the housing supply quick enough. And as a result, we've had skyrocketing rents. And these rents are one of the biggest drivers of our CPI inflation. So when your rents go up and your building costs go up, and part of that building cost is the building sector's become less efficient, but it's also we've got more demand, which then drives up costs. And housing inflation is 20% of the inflation basket. So that's also reducing, feeding into inflation. And it means that people become less productive because they end up living in suboptimal places, like they don't live as close to work, that sort of thing, which makes them less productive. So that's sort of the one of the main long-term drivers of why Australia's productivity growth has become so poor. And in fact, you can see the second chart from the left, which hopefully you can see my mouse cursor circling it. That there is a chart of Australia's immigration rate, which is, I think, in green. And then you've got per capita GDP and our labour productivity. And I've done the immigration rate inverted. So otherwise, you can't see them together and look the other way. But you can see as the immigration rate's gone up, our productivity has gone down, labour productivity has gone down, and our per capita GDP has gone down. And again, that relates to this capital shallowing story. And it's not just that. It's also our migration system, despite what they say, is actually not very skilled. So if you're bringing in a lot of people that are unskilled, they're going to be less productive on average, which also harms your productivity. So that there is one of the main long-term factors of why Australia's productivity growth stinks. And it's also why if we keep running the same immigration program that we've done for the last 20 years, which is mass migration, and a lot of it very low skilled, and we continue to grow the population faster than business investment, faster than infrastructure, faster than housing, we're just going to get continued capital shallowing, and our productivity growth is going to continue to stink, which then means our income growth, our material living standards aren't going to grow. But of course, it's not just the only factor. There's other factors as well. So also, we've had, obviously, oodles of housing malinvestment. So because of Australia's tax settings, etc., Australia pours way too much resources into existing housing, and that's pumped up land prices, which makes land's a factor of production if you're a business or whatever. It also pumps up commercial rents, that sort of thing, makes it more expensive. But most importantly, and this is sort of shown in the chart in the bottom right, Australia's entire banking system has morphed into a giant building society. So it used to be that back in the early 90s, banks led about 2/3 to businesses and less than 1/3 for housing. The other bit, which isn't shown here, is personal lending. But that has completely flipped the script. As Australia's housing bubble has surged, and we've had more and more property investors piling into established housing and all that sort of thing, the entire banking system has become incredibly heavily weighted towards mortgage lending, which is unproductive. So effectively, business lending has reduced, mortgage lending's increased, and you obviously want your banking system to lend for productive purposes, which is businesses, generally speaking. And I'm sure that's one of the reasons why this business investment has been so poor, which then feeds in the productivity problem we've got when you're growing the population too fast. And then the next problem we've got with productivity, and this is more of a recent phenomena, it's this excessive growth in the non-market economy. So what the non-market economy is, that's basically your public sector, your traditional public sector, so bureaucrats, that sort of thing, the education sector, and also the healthcare and social assistance sector. Now, the reason why they're called the non-market sector is because they're basically funded by government. And there is a sector that's not actually included there, but could be, and that's, say, your utilities. So we've actually seen very strong growth in utilities because there's renewables built out as well. But this chart at the top left shows that since the start of 2023, basically 2/3 of jobs, I think it's 69% of jobs up until the third quarter last year, because this data is only quarterly, were in the non-market sector. And that is mostly related to the expansion of the NDIS. Now, the problem with it is these non-market sector jobs have experienced incredibly poor productivity growth. You can see that in the chart next door to it, which is from Alex John IFM Investors. That's the gross value added per hour worked. You can see the productivity growth in this non-market sector has actually declined, been declining every year since 2015. And in fact, it's tracking at the same level as it was 20 years ago. So the traditional market sector has experienced decent productivity growth, but the problem is because the economy has become more weighted to the non-market sector, and that's where most of the job growth is, this lack of productivity growth, or negative productivity growth, I should say, in the non-market sector is now also dragging down Australia's overall productivity growth. And the final factor is obviously expensive energy. So Australia's obviously completely stuffed up energy policy across the board. So we don't reserve gas on the East Coast, and despite the fact we export 3/4 of it, we've got incredibly expensive. We've got domestic gas shortages, very high prices, etc. We've also got very high electricity prices. Now, it's partly because of the expensive gas, but it's also because we're going down this path to renewables and net zero and everything, which is very expensive. But the key point here, and this is the chart on the far left, the bottom left, from Alex Jordan from Investors, you can see that the cost of energy, now the cost of energy for households has gone up as well, but it's particularly important for the manufacturing sector because costs of energy have soared, both for electricity and gas, and energy is an absolute key input into the manufacturing system. If the cost of energy goes up, obviously the cost of manufacturing goods goes up a lot because it's a very heavy user of energy. It's also led to deindustrialization because thousands of manufacturing firms in Australia have gone bust in recent years, and all the way from small manufacturers to Oceanic Glass, which was Australia's last architectural glass maker, Quenos, which was our last plastic maker. We've lost fertilizer companies, Orica, which makes explosives for mining. and fertilizers, as you know, talked about downsizing and shifting its production to the US because energy is cheap there. Blue scope steel the same. Because of this high energy costs, Australia's manufacturing sector, and look, to be honest, it's been shrinking for decades because of getting rid of the tariffs, and we had the expensive Australian dollar during the mining boom in the 2000s, which made manufacturing less efficient. But recently, the manufacturing sector has also been getting hammered by these high energy costs. And what that's done is it's obviously shrunk the manufacturing sector, and this is negative for productivity growth because Australia has the smallest manufacturing sector in the OECD now. It's only about 5% of the economy. And traditionally, manufacturing has been one of the areas where you do get strong productivity growth because it can be you can automate it, or you can invest in capital equipment like machines and that sort of thing. And when you do that, you become a lot more efficient. But because Australia's manufacturing sector shrunk so much and we're deindustrialised and sent manufacturing offshore, we've become more reliant on these sorts of jobs, NDIS type of jobs, and less reliant on these sorts of jobs. And as a result, the nation's overall productivity growth has shrunk. So I basically call those things the four horsemen of the productivity apocalypse. One, immigration that is higher than the nation's capacity to build, the nation's capacity for business investment, infrastructure, and housing. That's the number one. And I'll just add that since the Second World War, the majority of Australia's productivity growth has come from this capital deepening, providing your workers with more capital. But unfortunately, as I've said, we've gone the other way. We've actually had capital shallowing. Number two, we've got obviously very expensive energy, which just adds cost throughout the entire supply chain and makes you less productive and sends your manufacturing broke. Number three, we've had this incredibly strong growth in the non-market economy, thanks largely to the NDIS, and those jobs, low productivity growth, and also they're government funded. So that's also smashed productivity growth. And finally, we've had this 20-year housing bubble, or 25 years really, which has caused malinvestment and sent a lot of the nation's capital into pumping up house prices and established homes rather than being invested in the real economy. And we've seen the banking sector basically be diverted into lending for non-productive housing, most of it established homes, not even building new homes, rather than lending to businesses, which then feeds back into this lack of business investment. So those are sort of the self-reinforcing issues we have that are basically causing Australia's poor productivity growth and ergo Australia's poor income growth. And unfortunately, there doesn't seem to be any appetite for Australia's politicians to actually address any of this stuff, which means that if they don't address it, we're going to have continued poor growth in living standards, but also means we're going to have continued high inflation. And the reason for that is because we're not growing the supply side of the economy because our productivity growth is so poor, it basically means that the economy is speed limited. And every time there's an increase in demand, and at the moment we're getting that demand through record government spending, it means that the economy butts up against these supply constraints and it just ends up feeding higher prices rather than increased output. And when you have those higher prices, you then have the RBA come back and now they're hiking interest rates to try and kill the demand side of the economy to try and bring inflation back under control. So if we don't get this productivity thing going, we're not just going to experience slow growth in per capita GDP, but also means that whenever we have an increase in demand for whatever reason, so at the moment it's record government spending, it's just going to feed into inflation rather than increased output. And that ultimately means that we're going to have higher interest rates for longer as well. So really, we've got to put this productivity thing front and center, or politicians need to. And we had the productivity summit, last year, just a big talk fest. Didn't actually do anything. There was no concrete outcomes, just like all these talk fests. The government doesn't seem to be taking this seriously and needs to.
Absolutely. And a couple of interesting observations I want to make. You started on the wage price index. Now, that has traditionally been the way that wages growth or otherwise has been tracked. But in the Statement on Monetary Policy, the RBA has now started to shift towards the discussion of an alternative index, which includes superannuation payments, people moving between jobs, and overtime, right? And they're all saying, well, actually, that's a little higher. And of course, Matt Canavan in the Senate basically said, RBA, you're gaslighting. The truth is that, real wages aren't going up at all. They're going backwards. The other point is that the wage price index and even the new RBA one is before tax. And the issue that we got to link back here, you talked about high government spending. Well, that equals high government debt. That means that more debt has to be covered, which means that we have to charge higher taxes. And the tax take is a lot higher than it used to be. And in fact, if you look at it across the board, it's the growth in taxes, even more than the growth in interest rates, that are hitting households overall. And there is no real discussion in my mind of the real take-home pay post-tax of households other than what I do in my modelling. And that's the other bit of the puzzle that I think is being missed.
Yeah, absolutely. So you raise a good point there, because obviously when you have a period of high inflation, whatever, and then you have some catch up with wages, nominal wages, it puts people into higher, not necessarily higher tax brackets, but it does increase your average tax rate, because more of your income that you get is in that higher tax band. So every time someone gets a pay rise, even if it's below inflation, their average tax rate creeps up. And that means you get less disposable income. So yeah, that wage price index chart is basically just it doesn't reflect your take home pay, and it means that in fact, if you were to factor the rise in tax rates or average tax rates across the economy over the last 5 or 6 years since we've had this big decline in real wages, it'd actually be a lot worse. And it's probably even worse in the real household disposable income per capita, because the growth in the working age population has been greater than the growth overall, because we're having less children, that sort of thing. So if we actually adjusted by working age population growth, it's even worse again. I think I did actually work that out once a couple of months ago using the RBA's data. And it turned out that the decline in real per capita household disposable income is actually worse if you use the adult population rather than just the per capita population. So obviously none of these measures are perfect, but I generally like to use them for a sort of trend measure. But definitely, if you're looking at after tax earnings, it's even worse, because as I said, whenever you get a nominal pay rise, even if it doesn't keep up with inflation, which it hasn't over the last 5 years or 6 years really, well, your average tax rate goes up. So you're actually losing more in tax, which means that your disposable income is actually less. Now, the real per capita household disposable income does capture that to a degree, because it does capture changes in tax rates, also changes in mortgage rates, that sort of thing. But again, it's still not a perfect measure.
And just to say, of course, also that the superannuation number went up, right? Because people are now being forced to put
that should not be counted.
No,
because it's certainly not disposable.
Exactly, but that's what's included in the one that now the RBA is preferring to use.
Counted.
That is a nonsensical. It's 12% now, isn't it? I think so. It's a big number.
Yeah, it is. It is. So no, you're right. That is duking the stats, right? Because obviously it's a higher share of your wages you now lose in superannuation than you did 5 years ago, because the amount's gone up, and it's not disposable because you can't access it. Okay, yeah, sure, it'll be disposable so I'm 48 now. It'll be disposable for me in, I don't know, what is it, 12 years or something? But it's not disposable now, so it's pointless counting it. That is just a pure duke the stats statistic from the Reserve Bank of Australia.
And of course, we have a few others with regard to how measure of inflation, how measure of employment or unemployment. All of those things are a bit fuzzy, right? Conveniently fuzzy on the downside, I think, quite often, which means that actually, until you actually get to look at real household budgets and to see the impact of all of these things, I don't think people actually get just how serious it is. Not for everybody. There are some people doing really well and they've had significant pay rises and they've got assets that are growing, stock markets or property, et cetera, et cetera. So effectively, the only growth lever that has really increased, quote unquote, wealth is this massive surge in home prices. If you sort of strip that out. Fake. Correct. That was going to be it is not real.
No, it's not. I mean, I've said this before. So I honestly believe, Australia always ranks like second in the world on household wealth. And we ranked second in the world in household wealth. Like if you use the, Credit Suisse / UBS study, whatever, which comes out every year, we're always ranked about second. And the reason why I rank second is because we've got expensive housing. And housing in Australia comprises a much greater share of household wealth than it does in virtually every other country in the world, except I think New Zealand might be, well, it was more concentrated before their bubble burst. But, so obviously if you've got expensive housing, well, then it's going to say that Australians are rich, right? But it's such a stupid measure because, I've used this before. This house I'm living in now, which I've owned since, actually I do, yeah, almost own it now. Owned since 2013, January 2013, I purchased it. It serves the same purpose, whether it's worth half the value it is now or worth double the value it is now. It's ridiculous. Like I'm living in here regardless. And if I sold this place, so say it doubled in value and I sold this place and bought somewhere else in Melbourne, well, you buy and sell in the same market. So the next place, because I've got to live somewhere, the next place I've got to purchase, I'll just pay more for, and you end up paying more in stamp duty. So it's not real wealth. And I honestly believe that, and also I'll add that I'm then robbing my children, who are now teenagers and who will need to buy a home in about 10 years, of their future wealth, because if my house goes up in value, it just means when it's their turn to buy, they'll have to sacrifice a higher share of their lifetime's earnings to purchase a home. So they're actually worse off. So I honestly believe Australia would be better off if we never had this big house price boom and our homes are worth half what they are now. So the median house price in Australia, instead of being, 900,000, I think in the capital cities thereabouts, we'd be better off if it was 450,000 and household debt to income was, say, 90% instead of 180%. Like if we had half of everything, we would be so much better off, because housing serves the same purpose no matter what the value is. It's just here to provide shelter. And if our homes had never had that rapid house price appreciation, and if it was worth half as much as they were now, we had half as much debt, we'd be better off because we'd have more disposable income to spend on other things. But according to the Credit Suisse UBS household wealth survey, we'd be right down towards the bottom end if we never had this housing boom. But we'd be better off. We'd actually be richer as a country, because it is largely fake wealth, right? All we're doing is depriving future generations of housing, or making them spend a higher share of their lifetime's earnings just to put a roof overhead than previous generations did. How is that making society better or wealthier? It's not. It is complete farce. And I think this is one of the things I dislike about Australia, is it's got this obsession with housing wealth. Like for most people who don't own investment properties and just own the house they live in, whether it's worth 3 times as much as it is or half as much, it makes no difference. Obviously, if you've purchased, you don't want to see your house half in price if you got a mortgage, because then you're negative equity. But the counterfactual is we never had this house price boom in the first place. And we would have been better off country if we had. And we certainly wouldn't have the malinvestment. We'd have banks lending more to businesses instead of just concentrated mortgage lending, because that's the easiest way to make money. And the capital rules from the Basel capital rules, unfortunately, favor that, which helps create the distortion. But we'd be a much wealthier country if we'd never done that. And we'd also be a much wealthier country if we had a smaller population. So Australia's population at the turn of the century was 18.9 million people. We're now about to, literally in weeks, about to cross over 28 million people. I argue that if we were, say, 22 million people instead of 28 million people, we'd be far better off, because we still would have had the mining boom. We still would have sold the same amount of iron ore and everything else, because none of that depends on your labor, really. It's hardly anyone works in it. But we'd be spreading those exports, that extra tax revenue, that mineral wealth over fewer people. And therefore, we would have been better off per head. And, often people say, oh, no, you're full of it, that sort of thing, often when I say this sort of stuff. But the counterfactual is Norway, right? So Norway does tax its resources properly, and admittedly, we don't. But Norway has a sovereign wealth fund so Norway's 5.5 million people. Because it taxes its oil and gas properly, like we don't tax that stuff properly. The government still gets a lot of revenue from it, though. It has a sovereign wealth fund that's now worth $300,000 $100,000 US per resident of Norway, right? So do you think Norway would be better off if its population was 11 million rather than 5.5 million? Of course it wouldn't, because its sovereign wealth fund, instead of being 300,000 US per citizen, if it doubled its population, it'd be 150,000 US dollars per citizen, because it'd be spreading its mineral wealth over fewer people. But Australia stupidly thinks that growing the population aggressively, when our top 20 goods exports all come from the regions which don't rely on population growth, and they're all either mining or agricultural based, we think that it's a good idea to do this. Well, it's not, because you basically are spreading your mineral wealth over more people, which just means that we get less per head. And the federal government wants to grow a population by, well, the official projection is for Australia to be 41 million people by 2065, 66, which is about 13 million more than it is now. Basically Sydney, Melbourne, and Perth extra. Well, that's not going to make us wealthier. It's going to make us poorer, because we are, whether you like it or not, we are a mineral. We basically pay our way in the world by selling off our fixed mineral endowment and agriculture. That's, again, a top 20 goods exports of that. So if you grow the population by roughly 50%, well, obviously you're going to dilute that wealth, and you're going to be worse off per capita. But that's the Australian growth plan, and it makes absolutely no sense.
And it's just worth reflecting, because, of course, there was an earlier growth plan that the statistical bodies had actually created some time back, right?
Yeah, it is. So I just made a mistake. So there we go. Sorry.
Okay. So
let's fix that.
Yeah, that's come back on, no probs. So, if you go back, what the ABS thought was going to happen some time ago and what has actually happened, I mean, it's a bit of a giggle, really, isn't it? Because it's so far off where we are that it's painful. But it is worth, I think, just reflecting on it for briefly.
Yeah. So as we know, since the end of 2019, Australia's experienced the strongest immigration in the nation's history, right? So the last 5.5 years, so you'd say 5.5 years because we only got data to mid last year. So that's 5.5 years since the end of 2019. Australia's annual immigration has averaged 266,000 a year. Now that includes the pandemic border closure, right? So that's when that's when the borders were shut. That is the strongest 5.5 year period in the nation's history, bar none. Right. So, extreme growth. We've more than caught up for the, catch up migration from the pandemic. So we've more than caught that up. Now, just for fun, I went through the ABS's old population projections a few weeks back, and I've got the headline data here showing. So this was the ABS's population projections from 2003 all the way through to 2101, right? But I'm not going to focus on the 2101 figure. I want to focus on the 2051 figure. And what the ABS projected as their baseline, steady state migration number was 100,000 per year. And they chose 100,000 because that had been the sort of normal migration up until that point. So, for example, in 2000, when we had the Sydney Olympics, I'd argue that was peak Australia, right? That was when Australia was almost the last time it was at its best. Our net overseas migration that year was 110,000. And it had taken 12 years up to the 2000 to grow the population by 1 million people via net overseas migration. The latest migration data we had from mid last year, so the June quarter of last year is the latest, it had taken only 2.5 years to grow Australia's population by 1 million people. So in the year 2000, we were basically grown by migration less than a quarter as quickly as we have recently. Now, in 2003, the ABS projected that Australia's population, with this 100,000 net overseas migration on average over, that was their long-term projection, they projected Australia's population by 2051 would only be 26.4 million people. Now, just think about that for a sec. So we're currently, according to the ABS population growth, very close to, weeks away from passing 28 million. So we're basically 1.6 million people above what the ABS projected for us by 2051. And we've hit there 25 years early. So 25 years earlier than they forecast back then, we've got a population that's 1.5 million greater than it was forecast to be in 2051. This is nuts. And Sydney was projected to grow to 5.65 million people by 2051. It's already there. So Sydney's already met its population projection 25 years early. Melbourne's even worse. Melbourne was only forecast to hit 4.8 million by 2051. And it's already beating that by about 700,000. So we're 700,000 higher than what they projected 25 years early. You wonder why Australia has, all these problems with lack of housing, lack of infrastructure, etc. Now, here's the funny thing. The table on the left comes from their appendix. So what they did, if you actually read the report, they actually say, the ABS has modeled some more extreme, quote, extreme immigration scenarios. They actually use the word extreme. And the most extreme immigration forecast that the ABS could come up with was 200,000 per year on average. But guess what? Since 2003, we've averaged about 235,000 per year because the federal government ramped up immigration so aggressively in the mid-2000s, or from about 2005. So the most extreme projection they come up with 200,000 back in 2003, yet we've done 235,000. That is the fundamental reason why Australia has grown at 2.5 times the rate of the OECD this century. It is a fundamental reason why we have chronic housing shortages, rental crisis, lack of infrastructure everywhere across all our major cities. We're now facing water shortages, which are going to have to build energy guzzling desalination plants and that sort of thing, which is going to need more energy. This is just nuts. And to make matters worse, this ridiculously strong population growth that was 135 immigration, which is 135,000 more than the ABS projected in 2003 per year, is forecast to continue forever because the Centre for Population's latest forecasts show that over the next 40 years, Australia's net overseas migration is forecast to average 235,000 a year. Again, so we've just done 235,000 since 2003 on average. And the brainiacs at the Centre for Population think, you know what? It's worked so well, which it hasn't. We'll just continue it for another 40 years. And we're going to grow the population to 41 million people. 81% of this growth is going to be in the capital cities. So this whole argument that, the regions are shrinking, we need to grow the regions, is complete BS, because the lion's share of the growth is going to be in the capital cities. But literally nearly 200,000 of that 235,000 a year is forecast to be in the capitals, and under 40,000 is forecast to be in the regions, right? The capital cities are forecast to grow by 10.9 million people over the forecast horizon. And Sydney is forecast to go to 8.5 million people, so another 3 million people on top of what it's already had after growing by more than 2 million by about nearly 2 million since the turn of the century. Melbourne is forecast to go to 9.1 million people. Now, Melbourne was 3.5 million people when the millennium was rung in. So, at the end of 1999, Melbourne was 3.5 million people. It's now forecast to go to 9.1 million people by 2065, 66. So in 66 years, Melbourne, would have added, 5.6 million people. Like, this is just banana stuff. And you wonder why, and also, this is also bad news for the regions, because I'd argue that despite the fact that the regions provide the lion's share of virtually all of Australia's export revenue, which basically funds our imports, the region's share of the vote, the region's share of the population has been shrinking for generations. And it's just going to get worse, because currently Australia's regions account for 68% of Australia's population. According to these projections, by 2065, 66, the capital cities account for 68% of the current population of Australia. By 2065, 66, the capital cities are going to account for 72% of the nation's population. So Australia is just going to become more city-centric, with a few mega cities and Brisbane, Perth being large cities. And the regions proportionally going to shrink, which means that the regions are going to lose more political clout. More of the nation's vote is going to come from the monster capital cities. And I just don't think this is a very sensible situation because, again, the regions are basically who provide us our food. They provide us with virtually all of our export revenue, and their export revenue is the reason through iron ore, through all the commodity exports, through the agricultural exports, etc., is the reason why this country is rich in the first place, and our exports pay for our imports. So, you know, if Melbourne grows from about 5.5 million currently to 9.1 million in the next 41 years, what is Melbourne going to do? Like what export revenue, what industries, what globally competitive industries is Melbourne going to bring to the table? Like it's already a parasite. It's imports our like 2.5 times its exports for Victoria. I'm talking about. And where is the sense in just growing Melbourne into an absolute ginormous metropolis when it doesn't actually do anything? All it's going to do is bring in more people who are going to buy more imported crap, cars, computers, all this other stuff, when we don't actually going to earn any export revenue. And I just argue that this is a recipe for basically having a poorer country. Because all we're doing is doing growth for growth's sake. We're bringing a whole bunch of people to go and live in the capital cities to basically do BS jobs and services jobs, BS services jobs that don't actually earn us any international income. And, we would be such a richer country if we just followed the ABS's population forecast from 2003 and we grew at this moderate pace and we were 1.6 million smaller than we are currently, but we didn't get there to 2051, we would be such a richer country. We still would have had the commodity boom. We still would have had all that stuff, and we'd have way more tax revenue to play with per head and all this sort of thing. And we wouldn't have the crush-loaded cities. We wouldn't need to spend so much on boondoggle infrastructure projects like the suburban rail loop and that sort of thing in Melbourne, because we wouldn't have this growing population which needs that stuff. So, you just got to ask yourself, what is our political class doing here? We're just running this mass migration model for no good reason other than it lines the pockets of various industries, like various rent-seeking industries, like banks, like property developers, like retailers, big business like the Harvey Normans, that sort of thing. And also our universities who get to clip the ticket on students. And of course, the federal treasury loves it because the treasury collects 80% of the nation's tax revenue. And they just see higher immigration as a way to grow personal income taxes, but they don't worry about the cost of that, which then gets deferred on state governments through infrastructure and extra health spending and extra education spending, that sort of thing, which is why our state governments are now broke, especially the ones that don't have any resource base, like Victoria. Where is the sense of this economic model that we're doing? This big Australian model that has failed dismally for 20 years to raise living standards on virtually every metric. The quality of housing's worse. The material living standards have not improved. Our productivity stinks. It takes longer to drive anywhere. I live in Melbourne. There's now potholes everywhere on the roads. Like you can't, Victorians used to pride themselves on having the best roads in the country. And back in the 90s, or even when I worked in Canberra and used to drive between Canberra and Melbourne all the time, I used to always couldn't wait to cross the border into Victoria because the Hume Highway back then in New South Wales was terrible. It wasn't even divided the whole way. There was potholes everywhere, etc. And when I got to Victoria, it was like smooth, a beautiful, smooth road, really good quality. Now it's the opposite. I drove to Port Macquarie over Christmas from Melbourne. I'm telling you, the roads are better in New South Wales than Victoria. There's bloody potholes everywhere in Victoria now. The whole place is falling apart. And part of the reason why it's fallen apart is that, the population has exploded here. The state government is completely broke, partly through, obviously partly through mismanagement, but also because it's trying to build all this infrastructure to keep up with population growth. It never keeps up. The infrastructure that we wouldn't need if we didn't have the population growth is becoming uber expensive. And, the state government's now drowning in debt. We don't have enough hospitals. We don't have enough schools. Living standards are just getting worse. And now our kids are expected to live in high-rise dog box, shoebox apartments. Like, how is this an advancement in our living standards? It's just ridiculous.
It is absolutely ridiculous. And I actually have said for some time that I think Victoria and Melbourne in particular is a bit of a canary in the coal mine, right? Because it's effectively signaling what happens when you let this stuff rip and when you actually do some dumb things. And this is a set of policies that, of course, have been around for quite some time. And I spent many happy months in Melbourne in the early 2000s, 1999 to 2000. And
It was great back
it
then.
was great. It was lovely. Yeah. And having come from the UK where it was, pretty congested in and around London, both Sydney and Melbourne were a delight to drive around and walk around, and the public transport worked, and the prices of getting around was so cheap. It was just a remarkable experience. And it's been degraded over the last 20 to 30 years simply because of bad policies that are consistently repeated. And that's really the point. One of the things to highlight here, this is not just Albo's problem. This is a problem that has been 30 years in the baking. And when I started doing my shows in 2001, I had my first conversations on the ABC, worrying about this issue of what's going to happen to housing if you actually let this stuff rip. I could see the seeds being sown that was going to lead to this disaster, and it's here, unfortunately. Now, interestingly, though, Leith, there are some counterfactuals, right? If you look at Canada and New Zealand, if you turn the migration knob down, things change.
Yeah, absolutely. So, Australia's obviously we're experiencing a rental crisis, and it keeps getting worse. And just before I lead into Canada, it's worth pointing out to say where Australia's going now. Cotality put out a report a week or so ago, and they basically showed that that rents in Australia in the last 5 years have grown roughly 3 times faster than wages, which is pretty obvious. And that's the chart on the left from Cotality. And Cotality's latest housing affordability report, which is up to the data's current as of the September quarter of last year. So it's getting a little bit, it's like 5 months old now. But what it showed is that rental affordability, so that's a percentage of income required to meet median rents in the country, was at the worst level in history. And according to Cotality's rental data, rents have increased by 43% over the past 5 years. So that's up to January. And that's added about $10,600 annually to the cost of renting the median home in Australia. So you're taking the Australian average here, not capital cities, just the nation as a whole. It's actually worse if you take a capital city average. But when you think about it, so if you're the typical renter now, you've got to spend $10,600 more to rent the median home than you did 5 years ago. And that's after tax money. That is an incredible amount of money to give up, extra money to give up to rent a house. Or rent a dwelling. Could be an apartment, whatever. Just the median home in Australia. And obviously with this mass migration, as I said before, it's been the strongest 5.5-year period of migration in the nation's history, 266,000 average net migrations annually, and that includes the pandemic closure. So incredible numbers there. We've seen this explosion in rents. Rental vacancy rates are tracking at historical lows. The latest data from Cotality shows that rental listings in the last 12 months have shrunk quite significantly by about 16% across the combined capitals. So the market continues to tighten. And the worrying factor is, this is shown in the bottom right-hand chart from Cotality, Australia's rental growth is now picking up again. So the growth in advertised rents, they were starting to come down at the end of last year. And now it's surged again. And now it's growing by about 5.5%, which again is faster than wages. So what that tells you is that even though, it's not the breakneck pace it was 18 months ago or 2 years ago, rents are still growing faster than wages, which just means that rental affordability is going to get even worse. And it's going to continue to get worse. And in fact, Cotality forecasts that the situation is going to continue to worsen in the rental market because we just don't have enough rental supply to keep up with demand. And demand is obviously population growth, which the fundamental driver is net overseas migration. So it's going to get worse. Now, the counterfactual is Canada. So Canada, like Australia, had an absolute explosive immigration policy after the borders reopened after the pandemic. And that's shown very clearly on the chart on the left, which is from the National Bank of Canada. Now that chart was taken at the start of 2024. So the data only goes up to the end of 2023. But as you can see, rents rocketed. Canada's population growth rocketed from migration, a 1-for-1 correlation almost. Population explodes, rents explode. But unlike Australia, the Canadian government actually did the right thing. right? So part of it was because they were under heaps of pressure from the public. But regardless, the Canadian government in mid 2024 basically imposed a 3-year population pause. So they said they want to basically pause the population growth for about 3 years. And what they did was they basically brought in, they lowered the permanent migrant intake by about 20, I think it was 25%. And they also put in a policy to reduce the share of the population who are temporary migrants. So they call them non-permanent residents there, from 7.5% at its peak in 2024 back to 5% by 2027. So they're gradually trying to basically send temporary migrants back home to shrink the number. And it's actually worked, because as the center chart shows there from the National Bank of Canada, Canada's annual population growth has fallen, but also Canada recorded its first population decline. I think it was 76,000 decline in the September quarter of last year. It's its first population decline outside the pandemic, I think, since the World War II. And this decline in population growth has worked wonders for Canada's rental market. So Canada's asking rents in annual terms have fallen for 16 consecutive months. That's the chart on the top right. Rents are down about 6.5% from their peak. This is now saving the average renter, or the median renter in Canada, $145 per month. So rents now are $145 per month cheaper than they were in mid-2024 before they cut immigration. And rental affordability is tracking at its most favourable level in 6 years. So that's the chart on the bottom right. So the Canada's rental affordability, so the share of income required to rent, is now below 30%. And hasn't been there for about 6 years. So you can see that the data, that if you look at the trend in asking rents and the trend in affordability, it's all going the right way. Rental affordability in Canada is improving. They've effectively solved the rental crisis, or in the process of solving the rental crisis. And why are they in the process of solving the rental crisis? Because they've cut immigration, right? None of this is rocket science. But unfortunately, our dumb government, and Albo came out on the weekend in an interview with Sky, basically said, no, he's not going to cut immigration. Well, if you don't cut immigration, you keep running at this high level, you're basically guaranteeing that the rental crisis is going to continue and rental affordability is going to get worse. And instead, the centre-left government of Canada, the Liberals, which are actually, it's not the Liberals like here, it's actually like the Labor Party. The Canada, which was regarded as even more woke than Australia, saw the writing on the wall, and they decided to actually cut immigration, and it's solving the rental crisis. But our dopey government won't do the same, which is ridiculous. And in fact, New Zealand, similar story. So New Zealand doesn't have negative population growth, but its immigration has collapsed to 14,000 last calendar year. And that was down from a decade average of 40,000 and a peak of about 130,000 in the post-pandemic surge. So New Zealand has massively reduced immigration. And surprise, surprise, New Zealand's rents have also fallen. So I've got the middle chart there of rental bonds, negative. And Justin Farber, Antipody Macro, has done some great charts on the top right chart. There is New Zealand CPI rents inflation and their private rentals. As you can see, the growth has tanked. It's tracking close to zero now. And this is all because shown by the bottom right chart, which basically shows the difference between demand via population growth and supply, new dwelling construction. And you can see that now the construction is running well ahead, like dwelling starts are running well ahead of population growth. So New Zealand is also solving its housing shortage by simply running a low migration policy. So, what is it that our idiots don't understand? And anyone who might be watching this going, oh, no, look, there's no relationship between rents and population growth. They've got a fantastic chart from Jared Minack, which I just need to find. Sorry. Here we go. Got it here. Bottom right-hand side. Jared Minack did this chart a few weeks ago. Bottom right chart. You can see fast population growth drives housing costs. He's basically plotted the change in rents to the change in population growth, the working age population. Well, I don't know. That looks like a pretty strong correlation to me. What do you think?
Case proved. Absolutely case proved. Yeah.
So if we want to solve the housing shortage and rental crisis, It's pretty obvious. We need to cut immigration. In fact, one last point I'll make: the federal government's own advisor, the National Housing Supply and Affordability Council, said in black and white. That's the bottom left chart. So Shane Oliver forecast, I'll just go back a bit. Shane Oliver forecast last year that Australia's current cumulative housing shortage is somewhere between 200,000 and 300,000 homes. Now, the reason why he doesn't know the exact number is because it depends on what your assumption is for the number of people per dwelling, which is a bit ambiguous. But he forecast at the low end, it's 200,000 cumulative shortage across the country. At the high end, it's 300,000. And this shortage has developed since the mid-2000s when the government ramped immigration, right? So when the government more than doubled immigration from about 2005, the undersupply developed. And the undersupply almost disappeared during the pandemic when we had negative net overseas migration. We're still building homes. But since that returned, it's come back. Now, the money chart here is the one directly below that, so the bottom left chart. This comes from the National Housing Supply and Affordability Council. And they forecast that over the 5 years to 2028-29, that population demand, i.e. immigration, would exceed dwelling construction or the number of new homes that are built, net of demolitions, every single year over the 5 years that are modelled, and that the cumulative housing shortage that Shane Oliver said was already between 200 and 300,000 would worsen by another 79,000. Now, the National Housing Supply and Affordability Council based its population forecast on the Centre for Populations, which is basically the same as the federal budget, etc. So it's the government's own forecast. But here's the rub. It forecasts that if population growth comes in 15% stronger than the government forecast, which seems like it could be possible because immigration is running hotter than they thought, the housing shortage, instead of worsening by 79,000 over the 5 years, would worsen by 200,000. But here's the other thing, and this is the point that gets back to Canada and New Zealand. The National Housing Supply and Affordability Council, which is the government's own advisor, explicitly said, and that's the chart on the bottom left, that if Australia's population merely grows 15% slower than is forecast, so still grows and grows fairly strongly, but just not as fast as they think, instead of having a 79,000 shortage of homes, which is their baseline, we'd instead have a 40,000 surplus of homes over the 5 years. Now, if we did that, that means that Shane Oliver's shortage of 200,000 to 300,000 would instead be 160,000 to 260,000 because we'd actually eat into the housing shortage. But instead, our dopey government, and by Anthony Albanese saying he's not going to lower migration, he's basically endorsing the National Housing Supply and Affordability Council's forecast that the housing shortage will get worsened by 79,000 over 5 years, which is their baseline. Because if we don't cut population growth through immigration, well, then the shortage is going to get worse. And yet the National Housing Supply and Affordability Council says if you merely cut it by 15%, over the 5 year period, we'll actually have a surplus over that 5 years of 40,000. So we'll eat into that cumulative housing shortage that Shane Oliver estimates. We'll actually reduce that by 40,000 instead of increasing it by 79,000. So this just tells you that we are run by complete morons. And the federal government's own advisor has done a report to them, said, here you go. You're going to have a shortage over 5 years because population demand is going to exceed supply. But if you cut population growth by 15%, i.e. cut immigration, you'll actually have a surplus over that 5 years. So you think that a government who actually pretended to care about housing affordability and the housing shortage and keeps banging on about how we've got a lack of supply in housing, we need to build more, blah, blah, blah. You think they go, okay, we better moderate immigration like Canada has done, like New Zealand has done. And then we'd actually solve the housing shortage, or at least, mitigate it and eat into this cumulative shortage that we've built up over the last 20 years of mass migration. You'd think that's what a government would do. But our dopey government, i.e., Albo, instead came out on Sky News and said, we're not going to cut immigration. So, okay, if you're not going to cut immigration, you're not going to improve the rental crisis. In fact, you're going to make it worse because it's been getting worse. And if we continue with the same moronic policy, this is the whole thing. Definition of insanity is repeating the same policies over and over again and expecting a different result. We already know how this story plays out, right? We've just lived it. We've got the data to prove it. The empirical data is here. Canada's done something different and had great results. New Zealand's done something different and had good results from affordability perspective. but we're choosing to ignore that empirical evidence. And I'd argue that Canada's the better proxy here because it's a more similar economy to Australia in a lot of ways. And also, it had exactly the same migration surge as us post-pandemic, but they've actually done something about it. And as a result, their rental crisis is resolving. Our dopey government is saying, no, we're just going to keep the pedal to the metal on immigration. And then we're going to keep gaslighting you that it's a supply problem. Oh, we just need to build more homes, which is impossible when you have, super high construction costs. You have labor shortages. You've got interest rates going up, which makes it more expensive to build. We've seen massive insolvencies in the construction sector. The fact of the matter is the supply capacity in our home building sector is not enough to build more homes, to build the homes we need for the population growth that we're getting. So the only solution then is to moderate population growth and bring it in line with the supply side of the economy. Or actually, preferably bring it below the supply side of the economy like Canada's done and New Zealand, which means you then eat into that shortage. So we've got basically three options here. You keep doing what you're doing and things get worse. You cut immigration a bit, so it's just in line with the supply side, which means that the current shortage just remains the same. Or you cut immigration more severely and you actually eat into the housing shortage and you solve the rental crisis like Canada and New Zealand have done. But our dopey government chooses option number one, which is just keep the pedal to the metal and keep making the situation worse while they gaslight you and pretend it's a supply problem. Oh, we just need to liberalise planning, whatever. Like this whole notion that you can just, blanket change the planning to allow all this high rise, et cetera, is going to magically build homes. It's not going to do it because we don't have the supply capacity. And the pipeline of the pipeline of homes under construction is already overflowing. It's at record levels. And as a result, simply if you've got a full bathtub, adding more water to the bathtub is just going to make it overflow. It doesn't, it is ridiculous to think that you can just blanket zone everything and you're going to magically get all these homes built when there isn't the construction capacity to build those homes.
Absolutely. And of course, there was an interesting article from Alan Kohler over the weekend, specifically on building productivity. And he started with the CFMEU problem and said, well, that's part of the issue. But the issue is more broadly that actually it's taking longer to get stuff built. It's much more expensive than it was to get stuff built. And by the way, our capacity to build is actually already quite high on an international basis. So it's not like we're not building much. And so the whole idea of trying to actually drive supply up in an industry where, in fact, productivity is falling, right, it's just completely dumb. And yet, of course, the government is again highlighting the fact that, we just build some more. And they change the planning rules and regs and distort some of the price dynamics, by the way. If you look in some of the areas in around Sydney, where they've now rezoned, prices have gone up. Why? Because people are now buying with the prospect of redeveloping. So it's not actually providing, a like-for-like comparison with prices previously. And yet people are still saying, see, prices are still going up. No, it's going up because of planning changes that actually are not necessarily productive. So this whole issue of productivity in the building sector comes back around again. Everything is connected, right? Productivity in construction is a critical issue that, again, is not being addressed properly.
Yeah, and I've actually got some really good charts on that. So this is from an article that I wrote a couple of weeks ago, just on the productivity in the construction sector. And Alex Joyner's done a great chart here. Basically, you can see in the blue that construction productivity is terrible and it's fallen really sharply over the last decade, whereas the market sector, so basically, just private enterprise other than mining and agriculture and construction, it's actually experienced, fairly strong productivity growth. And this low productivity growth is part of the reason why we've had this blowout in the number of years it takes to build stuff, right? So, the number of years it takes to build units has rocketed. It's basically gone up from 6 years, a decade or so ago, to 9 years. So it's, that's a 50% longer to build units. Townhouses has gone up, not as much, but it's gone up, and houses has obviously gone up as well. And part of that's because this construction cost has gone up. We don't have enough labor or this sort of thing. It takes longer to build things, which is why if you just liberalize planning and say, oh, we're going to blanket open up the whole of Melbourne, say, to high-rise apartments, right? The YIMBYs out there will say, oh, great, we're going to build heaps more housing. Well, no, we're not, because we've already got a we already have a massive construction pipeline of homes that are yet to be built, and it's taken way longer to build homes. So if your pipeline's already full and you can't build what you've already approved, how does approving more properties lead to more construction? It doesn't. It just means you got a bigger backlog, right? Because you don't have the capacity. Now, interestingly, there was a great report here done by a guy called Jonathan O'Brien, chief of Inflection Points. He did some fantastic charts of how Australia's building industry has become more bureaucratic, right? Which is part of the reason why productivity sucks. And this chart here is fantastic. It shows the number of planners has increased by 7-fold over the last 30 years. So you see that blue line there shows the number of planners per completion has just rocketed, whereas construction workers per completion have gone up a bit, but not massively, right? And then you've got we build fewer than 9 houses per planner now, whereas back in the late 80s, we built like 60 or something, or 55 or 60. So it would just become more bureaucratic. And I think that's a repeated chart. And then of course you have this productivity growth across the entire, higher density construction, house construction, etc., has fallen sharply since the turn of the century. That's shown pretty clearly here by Australian Industry Group. And then of course construction costs have surged. So construction costs are up by about 40% since the start of the pandemic. So this whole notion that we can just magically build more homes is just delusional. And in fact, the ABC reported that there's something like 40,000 dwellings that have been approved in Western Sydney, but only 20,000 of them have actually moved to construction. So, and the reason why they're not moving to construction is because the cost to build them is more than people can actually pay. Like, they're too expensive to build, and people can't afford to pay what the builders need in order to make a profit. And that gets back to this cost issue. And there was an article also in The Age today that said similar. It said something like, the Victorian government's basically blanket zoned a whole bunch of areas in Melbourne for high density apartments, but only 18% of that, of the areas that they've zoned for density, are actually viable to build because costs are too high. So this whole notion that, planning's the problem, we just need to blanket zone stuff and we'll get more homes built, is just laughable, because the construction costs are just too high. The construction pipeline is already overfilling. We've already got a bathtub that's already full. So adding more water to the bathtub just means it's not going to help, right? It's going to make things worse. So, these are the realities here that I think the YIMBYs, the supply siders, etc., don't understand. And they need to sort of get it through their thick skulls that we have a supply constrained housing market, construction market. And with a supply constrained construction market, the only way you're going to solve the housing shortage is you've got to reduce the demand side. You've got to reduce population growth so that population growth is in line with your capacity to build, or preferably, as Canada and New Zealand have done, reduce your population below your capacity to build houses and infrastructure. And then you actually catch up on the bottlenecks and the shortages you have of housing and infrastructure, because for a time, you're going to build more homes than new people. You're going to build more infrastructure than new people. And therefore, you get that capital deepening thing that I was telling you about before. You're going to get more infrastructure per person rather than less, which is what we've had for 20 years. You get more housing per person than less, which is what we've had for 20 years. These are the only solutions we've got here. We've got it. This is why it's absolutely imperative that Australia lowers the migration rate, lowers it significantly, so that it's not continually exceeding the supply side of the economy. And we also should, I should say this, we shouldn't just run a smaller migration program. We also need to run a better targeted migration program. which gets skills that we actually need. So we need more high-skilled people, more people who are in genuine shortage rather than just increase the number of Uber drivers, which is basically Australia's existing approach. And according to the Gradden Institute, Build Skills Australia, etc., we have the proportion of migrants that work in construction is significantly less than the proportion of the Australian-born population that works in construction. So what that means is we're bringing in hundreds of thousands of people every year through migration, but a tiny share of those people actually work in the construction sector and can build homes for those new people that are coming in. So what it means is that Australia is adding to demand through migration far more than is adding to supply, because hardly any of the migrants are working in construction, which means that we're increasing the need for housing, the need for infrastructure, but the people that we're bringing in can't build that housing and can't build that infrastructure. And that's just another piece of the pie. We need a smaller migration system overall, and we also need to have a better targeted migration system, which has more of the skills we need, including tradies, etc., rather than the skills we don't need, like more Uber drivers, which unfortunately, as I said, Australia's migration system is predominantly unskilled. And we get people in areas that we don't really need rather than people in areas that we actually do need and we have genuine shortages.
Yes, it's interesting. If you look at the various classes of people coming in, I think real estate agents and masseurs are on the list, and a few others too. And you think, well, hang on a moment, is that really where we need to have the investment in, the skills that we need? Another interesting observation, Leith, is if you look at the recent approvals, the ones that are getting through at the moment are actually higher rise and also bigger properties. They're not targeting, the first-time buyers. They're not targeting the immediate issues around housing affordability. They are actually offering more exclusive properties for those who are interested in them, because, of course, they can make more profit on some of these more expensive properties. I'm thinking of Trump and the Gold Coast, perhaps the latest example, right? That's not really going to solve the fundamental issue with regard to the fact that there are many people who can't get into the housing market, are completely unable to afford to get in, are caught in the rental sector, having to pay more for rent. And just linking that back to an earlier point, the metric that is used as advertised rents doesn't include the increases in rents that are actually being imposed on people already in rentals. That is not actually captured in that statistics. And in fact, in my data, I'm seeing a lot of people getting more rent rises in the property they're currently in. They can't move because they've got no choice but to stay where they are. So again, it's all part of a puzzle that is not being well represented, again, in the mainstream conversation.
Yeah. And again, it gets down to this, these useless policymakers we've got in this country who don't address real issues, and they don't address the cause of a lot of our problems. So, obviously, I've talked a lot about the migration problem we've got, but clearly, if we're going to solve the rental crisis and the shortage of housing and stuff like that, there really is no choice but to moderate immigration significantly. And again, try and make it more skilled towards target the people we need. Obviously, we also need to solve the energy issue. So, again, I've said this previously, I won't bang on about too much because I don't want to cover old ground. But we are the biggest coal exporter in the world. We export 7 times more coal than we burn ourselves. We are the second biggest gas exporter in the world. We export 4 times more gas than we use ourselves. We have 30% of the world's uranium. With a set of numbers like that, we should have the cheapest energy in the world. Like, I'm talking gas and electricity, not oil necessarily. But we should have the cheapest, gas, or some of the cheapest gas and electricity in the world. Not necessarily cheapest, but, at the lower end. Instead, because we've got idiots ruling us who make dumb policies, we now have very expensive gas and very expensive electricity. And that's feeding inflation across the entire supply chain, because pretty much doesn't matter what business you are, you rely on energy to a certain degree. It was obviously more in manufacturing, that sort of thing. But that's adding cost across the entire supply chain. And it's also sending our manufacturing offshore. So net, we think we're saving the world when we're 1% of the world's carbon emissions. And we've accounted for 0.3% of the rise in the world's carbon emissions this century, whereas China and India combined have accounted for 80%. right? Yet we sell coal to China and India. We sell gas, lots of gas, like most of Australia's East Coast gas, which is where we've got the shortages, goes to China. So okay for them to burn our coal and gas, but we're sort of made it so we've got to get off that stuff ourselves while we're happy for other countries to burn it. And as a result, we're deindustrializing. We're sending our industry off to places like China, and then we're going to buy it back off them, the value added on. We're going to put it on a ship that burns bunker fuel, which is one of the dirtiest fuels going around, and we're going to transport it thousands of kilometers back to Australia when we could have just made it here if we had cheap energy. Like, this is just clown show stuff. And the annoying thing about it is that China and India are continuing to mine more coal every year. They've planned to open up more coal mines. So China already mines 10 times more coal than Australia does. India mines more than 2 times more coal than Australia does. The difference is we export most of our coal, 7 times more coal than we use. China and India use all of their own coal. And then they buy coal from places like us, like Australia, to then burn more of it. And China and India are also opening up more coal powered generation. So, China has about nearly 1,200 coal-fired generators. India has like 250. Australia has 18. So we're planning to shut down all our coal generators while China and India continue to build more. They continue to burn more coal. They continue to buy our coal and then mine more coal of their own to use. Like, what are we doing here? Like, we could have cheap and reliable energy if we wanted to, but idiot policymakers are like, no, we can't do it. Not good for we can't let that carbon out. We've got to save the world, while we're literally 1% of the world's carbon emissions, and the, two economies that are like 42% combined and growing, just doing what they want. Like, we're not a serious country. In all these areas, we just do dumb things. And as a result, we get bad results.
Talking about dumb things, the CGT discussion currently is another example of essentially trying to solve something which is, well, a little bit of the puzzle, but not a significant part of the puzzle. But remember that CGT isn't paid when you buy, it's only paid later, right? So again, this is another example of posturing and, policy on the hoof and announceables rather than reality, in my view.
Yeah, absolutely. I've got some good charts here. I'll just quickly. So I just had a bit of some reason my presentation froze. So hopefully this doesn't.
Okay.
Hopefully you can see that.
Yep.
Okay, good. Sorry, I just lost it. I'm hoping that nobody heard it at home. We had a massive rainstorm just come through in the last 5 minutes. So hopefully you weren't hearing it at your end. I was a bit distracted because I couldn't hear because I've got a tin roof in this man cave, and it was coming down so loud I could barely hear anything.
Well, Zoom's pretty good at clearing the any noise in the background.
Excellent.
So, yeah.
You probably saw I was doing this, and I was
yeah.
It was. We had a huge thunderstorm just come through in Melbourne, and
I wondered whether I'd muted myself or something, but no.
Sorry, I was a little bit distracted for about 5 minutes there, so I was having hard to get my thoughts out because it was bucketing down, howling. Anyway, it's eased off.
Good.
So basically, we've got this. It looks very likely that the federal government is going to reduce the capital gains tax discount in the upcoming May budget. Now, pretty much they've been butted up to do it. There's a whole conga line of think tanks and other people, notable people, right across the political spectrum, who've basically said that, look, the capital gains tax discount is too generous, and it should be reduced. And look, to be honest with you, I have sympathy for that. I think it is too generous, and I think it has driven overinvestment in housing. It's been one of the reasons that have driven, too much property investors into the market. And I wish I'd put a chart here. I just forgot, as I always do. There's actually I've got a great chart, just not here, and it actually shows from the ABS housing finance data. It shows that basically there's an inverse relationship between the share of investors and the share of first home buyers. So when investor share goes up, first home buyer share goes down. It's almost a perfect inverse correlation, right? So if the capital gains tax discount has encouraged too many investors in the market since it was bought in 1999, that by rights means that first home buyers have been squeezed out, and also means that the Australia's home ownership rate also is lower than it should, lower than it would be otherwise. Now, there's been a whole bunch of, as usual, the usual suspects, the Real Estate Institute, and a whole bunch of, the property investment professionals of Australia, and all these other, groups have come out saying, no, you can't cut capital gains tax. If you reduce the capital gains tax discount, there's going to be a boycott of investors, and that's going to mean less rental properties, and it's going to drive up rents. It's going to make rental affordability worse. Right? That's the common claim. The problem with it is it doesn't make a whole lot of sense, because if an investor sells a property, well, let's say half the investors that are in the rental market at the moment sell over a 5-year period. Those properties don't disappear, right? Those properties will be bought by either new investors or owner occupiers. And what it basically means is that the share of investors that shrinks means that the share of first home buyers is going to increase. And what that means is that if investors leave, yes, you have fewer rental properties available to rent. We also have fewer people needing properties to rent because they become owner occupiers. And when that happens, the supply-demand balance in the rental market is unchanged. Now, Australia, fortuitously, has a pretty good, counterfactual here, because Victoria, in early 2024, the Victorian government whacked property investors with huge hikes in land tax, and also vacant land taxes and that sort of thing. And what it did is it has led to an investor boycott in Victoria. So you can see, I've got a chart here, the green bar chart, that is active rental bonds in Victoria. And you can see since that policy was brought in 2024, there's actually been a shrinkage in rental properties in Victoria. So the number of rental bonds has been shrinking for a good part of, 18 months or nearly 2 years. 18 months. You can see that it's turned negative. So what that means is when rental bonds are falling, it means that you've got fewer investment properties because the flow is negative, right? So we've had a net loss of investment properties in Victoria. Now, you think if that argument held, that if investors boycott the market or leave, that rents will go up, how is it that Melbourne's rents, and that's the quotality chart on the right-hand side at the top, how is it that Melbourne's experienced slower rental growth than all of these other markets, all the other major capital markets? Like, that shouldn't have happened. And how is it the rental affordability chart, which is at the bottom there, the portion of income spent on rents, how is it that Melbourne has now has one of the most affordable rental markets in the country? Like, its rental affordability has actually improved since this policy went in. Now, I'm not saying it's because of the policy, but the share of income in Melbourne spent on rents hasn't gone up much at all, and especially not compared to the other markets, because its rental growth hasn't been as strong. So this whole argument that that removing or reducing the capital gains tax discount will therefore lead to a decline in property investors, which will therefore lead to an increase in rents, just doesn't hold. It doesn't make sense, because the property doesn't disappear. It merely means that you're going to have less homes available for rent, but also less people needing to rent. So really, it's just a wash. So I personally favour this policy. I think it's a good idea, because it'll put some mild downward pressure on house prices, not a lot, because it'll remove some of that investor demand. But more importantly, it's going to mean that first home buyers aren't crowded out as much, and you're going to get a lift in first home buyers. And I didn't put these charts in here, but Melbourne's share of first home buyers in the market's actually higher than just about every other state now. So the investor demand's gone down, but first home buyer demand's gone up in Victoria, which is a good thing. And also means that if you remove the capital gains tax discount or make it less generous, I personally think we should just go back to the pre-1999 model, where basically we only tax real gains. There'd have to be a transition for existing investors, or grandfathering, that sort of thing. But if we go down this road, you're going to get some mild downward pressure on house prices, because you're going to have less investor demand, fewer investors competing with first home buyers, bidding prices up, means you're going to get less price growth. And other things equal. But more importantly, you're going to help to improve the home ownership rate, because you're not going to have as many first home buyers being crowded out and then forced into the rental market to then rent off the very property investors who've crowded them out. So yeah, it does seem very logical. Now, I was a macro business person challenged me today, said, well, doesn't this show, because Melbourne's rental growth has been less than these other jurisdictions, doesn't it show that if you reduce property tax investors actually makes rents more affordable? I don't think it shows that. And the reason for that is, sorry, this isn't working. I'm going to have to get out and then go back. My computer's just seized up. Sorry.
Too much stuff open.
I don't know. It's just, some reason since that rainstorm.
Or maybe it's the rain. It's the rain. Yeah.
Well, I actually do have a cord that's running up to my house in the backyard. So I'm hoping it doesn't short. But anyway, we'll find out. It's possible. I haven't seen rain like that for a long time in Victoria, in Melbourne. We've had a very dry summer. But I'll just share this. Hopefully, this I have to do it the long way. Unfortunately, I'm sorry. So here's some great charts, which I think explain the differing housing, not just the differing rental growth, but also the different house price growth. So according to Cotality and PropTrack, etc., Queensland, Brisbane, Perth, and South Australia's house prices have roughly doubled in 5 years, according to PropTrack. Sydney's have gone up about 45%, and Melbourne's have only risen by, I think it's like 18% since the pandemic in the last 5 years or so, or since March 2020 is the time period. Now, and obviously Melbourne's rents have gone up less quickly than those other jurisdictions. I think this chart, these charts from Alex Joyner and I from Investors, I think explain it very well. So what it shows is that, and these charts are about 6 months old, right? But you can see the trends here. Queensland, WA, and South Australia, their population growth has been in the last 5 years has tracked well above the pre-pandemic trend. This is the working age population, so the adult population. New South Wales, which again has had slower house price growth in these areas and also slower rental growth, but still solid, its population growth is basically tracking in line with the pre-pandemic trend. So it's caught up, but it's basically no higher than it would have been had the pandemic not come along. Victoria, on the other hand, its population is tracking about 110,000 fewer than the pre-pandemic trend. And the reason for that is, despite the fact that, Victoria still gets a lot of net overseas migration, we've actually seen a huge exodus of people from Victoria up to places like Queensland, etc., and to South Australia and the like. And a lot of that was due to the obviously, Victoria completely stuffed up the pandemic, and we had the 9 months of lockdowns, that sort of thing. And a lot of people want to escape. And I think that explains this difference in population growth versus the pre-pandemic trend, helps to explain why Brisbane, Perth, and Adelaide have experienced such strong house price growth. New South Wales, Sydney's experienced solid growth, but nothing as spectacular as those three places. And Melbourne has lagged the other states, and it's also lagged the other states in rental growth. It really gets down to this divergence in population growth since the pandemic across these markets.
I think that's an absolutely fascinating point at which to perhaps bring the conversation to a close, not only because we've run over time, but because it really cycles right the way back round, right? What we tried to show was that the productivity issue, the migration and population issue, the housing affordability issue, it's all linked. And the fact is that the policies that the politicians have been playing with for the last few years are disconnected. So they're actually pulling bits of levers that aren't actually necessarily getting to the right outcome. But there are some things that can be done. And in fact, there's a simple set of solutions that are out there that could really address housing affordability and really start to address some of the productivity issues that have been haunting Australia. So it does come back to policy choices. Unfortunately, our leaders at the moment, they're making the wrong choices.
Yeah, they are. As I said, they are completely doing the wrong things in lots of areas. So there's obviously the housing/immigration issues we've got, but also energy policy. I mean, what a disaster. That's all I can say. This is self-inflicted wounds. It didn't have to be this way. It doesn't have to be this way. But unfortunately, I don't see any real appetite, especially from the Labor Party, which, let's face it, has got a stomping majority in Parliament and could do virtually whatever it wants. Mm. It doesn't have any appetite to actually fix these things, and in fact, it's making it worse. We've just seen Albanese double down on this big migration, said he's not going to cut it, and obviously, we got Blackout Bowen and co. Diving headlong into this, wanting to shut down our baseload coal-fired, cheap, reliable generation, which has powered the country for generations and used to provide Australia with some of the cheapest electricity prices in the world, refusing to do, wanting to basically shut that stuff down as quickly as possible and shift to this intermittent, expensive, renewable future at the same time as we've got data centers being built, which require huge amounts of energy. We've got the population forecast to grow by nearly 50% over the next 40 years. Again, going to require a lot of energy. We're going to have, because of this strong population growth in data centers, we're going to need more water, which means we're going to have more desalination plants, which use more energy. And the government is also trying to, through its National Vehicle Efficiency Standard and subsidies for electric vehicles, etc., it's trying to shift the entire vehicle fleet onto electrification, which then is going to require a ton more energy as well. So if you're going to, ton more electricity, so huge population growth, data centers, desalination plants, and electrification of the vehicle fleet means that you sure as hell don't want to be shutting down your baseload coal, 25 gigawatts roughly, or 22 gigawatts. You don't want to be shutting that down and trying to replace it with intermittent, renewable generation that is solely reliant on the weather. Because if you do that, you're going to have energy scarcity and eventually blackouts and rationing and that sort of thing. But unfortunately, that's what they're doing. And then at the same time, the government has released a gas reservation policy that is basically a reservation policy only in name. It's going to do absolutely nothing to solve the shortages on the East Coast. So again, we've just got basically a phony government doing phony solutions to real problems. And as a result, unfortunately, productivity growth is unlikely to improve. And our living standards and housing situation is likely to get worse before it gets better.
Absolutely, Leith. Well, very, very thought-provoking as always. I always enjoy these conversations. We get a bit spicy. We really get into some of the deep detail, but also stand back and look at the overall architecture. And you can see that things are a bit of a mess, but there are options and choices that could be made. If people want to find out more about you and what you do, where do they go?
Yeah, so the best place is macrobusiness.com.au. That's where I write, lots of articles on these sorts of issues. And also got a YouTube where I just basically post on my media interviews, that kind of thing. That's just, if you put my name, search Leith Van Onselen or at Leithvo, Leithvo, you'll find it. Again, that's just, basically my media work.
Terrific. Well, thank you so much for that. And I hope you haven't got washed away outside when you go. I'll look forward to having another conversation with you, hopefully in about a month's time. And we'll see how the trajectories move, whether that expectation of rates is still there, and whether any policies have actually taken us in the right direction or the wrong direction. I think we know which way it's going to go. But thank you so much for your time, as always. Really appreciate it. And I'm going to take you offline now and I'll close the show. Take care.
Thank you.
So there you go, folks. Hope you found that stimulating and interesting, if a bit frustrating, because, of course, we know that there are things that could be done. Just a quick shout out to Jason. Jason, thank you as always for the super chat. Really appreciate it. Really helps us. So thank you very much for that. Next week, Damon will be on and we'll be talking about the markets and market dynamics. A lot to talk about there with the tariffs, of course, and the market dynamics and the AI questions. So plenty to talk about there. And the dogs are still here. Yes, they are. So they haven't moved yet. So my next task is to take them out for a walk and give them some food. Anyway, thank you for spending time with us this evening. Take care. Please check out the recorded shows put up every day and check out the next live show on Tuesday. This is Martin North from Digital Financials signing off. Take care.